Hello, and welcome to the Josh Brown Podcast. With over 40 years of combined financial planning experience serving high net worth clients, we will discuss our favorite topics, concepts, and stories.
Hello, and welcome back to the Josh Brown Podcast. I'm Phillip Saunders.
I'm Dan Joss.
And today we're going to be talking about 20 years of alternatives. So you've been doing this for over 20 years now.
Yeah, I think it's 25, 30.
25 or 30, wow. And I've been doing it for 3.5, so.
Good.
Combined experience here. Okay, so what are alternatives? We said not publicly traded traditional equity like stocks and bonds or ETFs and mutual funds.
Of stocks and bonds.
Of traditional stocks and bonds. Yeah.
That's what I'd say.
And so what does that mean exactly? We can go through all of those different things. So we've got a variety of things listed here, and we'll just kind of go through them. Something I wrote down here about alternatives is that why would you invest in alternatives? One reason is that it's probably lower correlation to, or it is lower correlation to stocks and bonds.
I think that's the reason for it and the design of it. It doesn't always
pan out that way.
Yeah, because there are alternatives that are supposed to have high correlation with the traditional stock. But we'll get into that too.
Or even over correlation. Yeah, that's a good point.
So we'll just say it's something that's not the normal stock.
That's not the normal stuff.
Yeah.
So the first one we have down here is real estate. So real estate investment trusts or REITs and mutual funds of those REITs.
Yeah.
So in terms of the 20 years of alternatives, REITs were included in the S&P 500 in 2001.
Yep.
That was when
they weren't widely used. And international REITs weren't available. All international REITs weren't available in 2001.
Right. Yeah, and so I've got those dates down here as well. Australia came out in the 70s with some REITs.
Yep.
South America in the 90s.
Australia and the US were ahead of the game.
Okay, yeah. REITs. And then Brazil was the South America in 93, and then more of those countries.
Yeah, France, Germany, all those European countries kind of did that in the early 2000s.
That's what I had, yeah. UK was in 2007. And then some Asian countries were in the early 2000s as well.
Yep. So what this just shows is that alternatives change over time.
Absolutely.
Because we would have said REITs were alternatives, something that was different from the normal stock bond portfolio 30 years ago. And now, because they're part of the S&P, they're looked at as kind of being traditional equity.
Yeah, and we were talking earlier, there used to be the different sectors of the S&P, and real estate was not one of them.
Right.
And now you look at the sectors, and real estate is one of them.
Yep.
So that's something that's changed over the years.
Although technically it's still different than a public company by definition of REIT, but practically speaking, it's kind of like another company.
It's a similar type
and many more people know what it is. So now we would probably say it's less alternative-like than all the other alternatives.
Yeah, it makes sense. In the stock market, you're buying a company, and that company has cash flows.
Yep.
In a REIT, you're buying a building, and that building a lot of times has cash flows. So they're similar in a lot of ways.
Yep.
Yeah. Another alternative is commodities, so gold, silver, oil, or agricultural products.
Uh-huh.
And so a few dates here. The first,
frozen concentrated orange juice.
Yes,
that's a nod,
absolutely
nod to trading places.
That's right. Yeah, and so you can buy futures on all of those things. So we were looking up the first futures, and I saw something about a future in Mesopotamia in the BC days. But I also saw in Investopedia the first future was in Japan in 1730. So the first, I guess, future that would be similar to how we do them today.
Well, and really how we do them today is very different than how we, did them 100 years ago, 50 years ago.
Surely.
Yeah.
Surely. So future what is it? It's I'll pay a certain price for a good, such as the frozen orange juice, for delivery at a future date.
Yeah. So in agriculture society, the idea of a future is you want to keep your farmers employed, even if it's a bad year for the crops. So I'll guarantee some amount for your crop, whether it's good or bad, which is enough to cover your costs plus a little bit more to keep you in business, so that if it's a bad crop, you can plant the next crop the next year. And if it's a great crop, that I get some profits.
Yep.
You get a little bit to stay in business, but I'm the one that took the risk. And the way the futures trader reduces their risks is they invest in orange juice and cotton and wheat and corn, all the other different types of commodities.
Pork bellies. Yeah. Diversification.
Yeah. So the farmer stays in business. The trader stays in business because one of those 10 is going to cover their costs and give them some profit.
Yep.
And everyone wins, even in bad markets. That's how it was in an agricultural society. Now we sell or buy futures against interest rates and currencies and other things that are more banking and finance related.
Yeah.
So in case the dollar falls and becomes worth fewer euros, I still have enough euros to get my inventory back to where I need it to sell it, or to move goods around the world. Or if interest rates change in an unplanned way, I'll still have enough cash in the future when I need the cash to pay off the life insurance that I owe to somebody, or whatever else a bank does. So commodity as a whole are a much smaller percentage of futures contracts than currencies and interest rates now.
Yeah, that's so interesting. Yeah, that's great. And so all of those products, a lot of those products that I named as commodities also have ETFs kind of them all together, or mutual funds or what have you. So yeah, that's commodities.
Yep.
The next one we have is fancy ETFs.
Nice.
And so an ETF would be an exchange traded fund. And so when we say fancy ETF, that's an exchange traded fund that behaves differently than a normal ETF with traditional stocks and bonds. And so some of those would be leveraged ETFs. Mm-hmm. So you could have a 2 times leveraged, 3 times, 4 times leveraged ETF.
Explain, what does that do?
And what that means is let's say you have a 4 times the S&P, then if the S&P goes up 10%, then your ETF would go up 40%, and vice versa. If it goes down, then it goes down 40%.
Well, we're seeing that in today's market too. These types of leveraged things are losing much more than the market is losing.
Yep, and then the bears would buy leveraged inverse ETFs, and so that would be if the S&P goes, let's say it's just an inverse 1 for 1. Then if the S&P goes up 10%, then your ETF goes down 10%.
And what we've seen recently is the markets are dropping, and those inverse ETFs are gaining,
benefiting from that. Yeah. And then you can have the leveraged ones where it's 2 times down, 2 times up.
Hoping for that 20% decline, so my leveraged ETF can increase 40%.
Yeah. We would not recommend that as a long-term strategy.
I wouldn't ever recommend our unique term of fancy ETFs.
Yeah.
It's not a long-term investment strategy, and there's costs, and there's tax consequences and a bunch of other things that go along with it.
So the first leveraged ETF was introduced in 2006. The first inverse ETF was actually introduced in the late 90s. There's also buffer ETFs, and so that would be, they have an upside cap. Mm-hmm. So you participate with the underlying investment up to a certain cap, let's say 10%. Mm-hmm. And then the way the way you benefit is if the market goes down. Well, then if it goes down 10%, that's your buffer. You don't participate in any of that loss.
Typically you don't get worse than zero. I've seen several of those.
But then if it goes down past that buffer, then you would participate in that.
Well, I've also seen where you don't lose any more than zero. You don't lose any.
So that cap's probably pretty low then.
Its cap loss is 0, and the cap gain is like 6%. So if the market goes up 20, you get 6. But if the market goes down 30, you get 0. So you come out ahead.
It's interesting.
And again, over the long run, it has to be profitable for the ETF. Otherwise, it'll go out of business.
Sure.
so their fees, there's costs that they're getting for that.
Absolutely.
But in the long run, we know stocks have gone up. So there's every so often there's a decline which you avoid. But if you have any kind of long-term horizon, you shouldn't fear a periodic loss.
Absolutely.
Yeah.
Absolutely.
And we saw that, what was it, probably a 3-year recovery after 08, 09 decline, and the same probably year recovery after 2002. So markets recover.
Yep, they have in the past, absolutely. So a couple of unique ones. I found an inverse Tesla 2 times leveraged ETF.
So it does
that's an interesting
risk and performance of Tesla stock times 2.
Times 2, in the opposite direction. Yeah, wrap your head around that one.
There's more ETFs out there than there are companies, stocks now.
And then I think another famous one is the inverse Kramer ETF. You've probably heard of that one. Picks the opposite of, or it doesn't pick the opposite. It does the inverse of what Kramer picks. Yeah. Another alternative is convertible bonds. So those came around in the mid 19th century.
Mm-hmm.
So that would just be a bond that at some point can convert to a stock.
Mm-hmm. And that's why it's been around a while, but it doesn't act like a stock or a bond because it's a hybrid of the two.
Yep.
And in good markets, it's stock-like. In bad markets, it's bond-like. And there's been times when we've recommended that.
Absolutely.
So it's not that alternatives are bad or good. They're just different, which is why we call them alternatives. And there are times to use them and times not to use them.
Yeah.
Good. Convertibles.
Yeah. A couple more. Farmland. So I hear it more and more these days. There's people who are investing in farmland all over the country. Land's becoming more and more valuable. Art and collectibles.
Well, that raises
an
an issue though, because we've had clients ask us, "Well, what about my house? Is that
investment?
Is that an investment?"
Mm-hmm.
I would submit no, because over the long run, personal residence with taxes and upkeep maintenance typically trail the cost of inflation. No real return.
Okay.
Now there are pockets of the country like D.C. and New York, and even at times those decline, but on average across the country, there's no real return. And we invest because we want a return that beats inflation. But the cost and the taxes of a home maintenance eat away those returns. So we would view it more of a lifestyle choice.
Okay.
Which school district am I in? Is there health care and entertainment near my house? Those are the overriding decisions, not investment.
Yeah,
maximize
there's
returns.
A lot of determinations that go into what house you buy and that sort of thing.
Right.
But
and that's different than, like we talked about earlier, REITs. Investment in commercial property for a profit. And if I don't get profit, I go out of business.
Yeah, and those cash flows they're cash flowing those things like maintenance and upkeep.
Yep, the costs.
Not maintenance, but taxes as well, those kind of things. So that all goes into
So and there is some residential real estate in REITs, but for the most part, it's non-residential real estate.
Mm-hmm.
Apartment buildings, strip malls, maybe farmland, radio towers, data farms, health facilities, retirement homes, storage facilities. All those are REITs.
Yeah, absolutely. Art and collectibles, those have been around for a while.
They have.
Another one is crypto and NFT. So in 2009, Bitcoin was created, and then NFTs, I didn't get the start of those, but in 2021, there was an NFT that sold for $69.3 million. So they're definitely out there in the headlines. Another alternative is IPOs, initial public offerings, and so that would be when a stock first comes on the stock market. And so you asked me, well, what have IPOs done in the past? Isn't averaging So between 1980 and 2022, IPOs returned an average of 19.6 in the first 3 years, which was roughly half of the average market return. And that was from Chris Heaton on MoneyWeek.com, an article he published on September 17th of 24.
So 19.6 total return for 3 years.
Exactly.
So like 6 or 7% a year.
Yep.
And we know stocks have done between 10 and 12, if depending if it's a large or a small cap stock.
Yep, exactly.
Cool.
Yeah, so
I wonder how many of those that made it to 3 years, how many of those that IPO'd didn't make it to those 3 years.
Oh, absolutely.
And that probably brought down that average.
Absolutely.
Yeah. Okay. And we don't recommend IPOs because what an IPO is a individual or a group of individuals trying to sell their private company for the most they can get out of it.
Yeah.
And so they're, for some reason,
they're salesmen.
Selling. They're selling their profitable business for some reason because they want to use their money somewhere else or because they want to lower their own risk. So it's interesting that they're trying to maximize and other people saying, oh, this is just going to keep going gangbusters up. Well, maybe, but maybe that maximum they can get out of it is it. And because once you've invented something new, sold a lot of it, brought the company to the market, you're kind of in a different business cycle where business is just kind of going to go along normal. There's no more new item for sale.
Yeah,
or
there's
new
different skills
new
required
service. Then it becomes
make that business continue to grow.
Right, and that's past the skill of the entrepreneur that started the company.
Yeah,
even within that phase of starting up to going public, there's like 10 other phases that each requires a new knowledge.
Yeah.
So good.
Yeah, it's interesting.
Too risky. When you could
very risky.
Buy a well-diversified portfolio and do all right.
Yeah. Good. The one that came to mind first for me when we said alternatives is this one. So venture capital and private equity. So you see that in the headlines a lot now. Private equity would be equity that's not on the stock market, not publicly available. And so, you pull funds together and then buy a company that's not on the stock market and hope that it outperforms. Yeah.
What else is not available publicly?
Private debt.
Well, I was thinking their financial statements.
Oh, sure.
Are not publicly available for scrutiny by thousands of investors.
Yeah, exactly.
So rarely,
and that's part of being public.
Rarely do we invest. Yeah, rarely do we invest in private equity, but we have, and then there's reasons to own it, and there's reasons to not own it. I've seen a big move towards more private equity becoming available over the last 10 years or so.
And there has been,
and that's a good thing.
Yep. After 2008, there was a lot of sources that were saying that was when private equity started to boom.
And a bunch of alternative investments too. Like we want 80% of the upside and only half of the downside.
The buffer, yeah, exactly.
Everyone wants 100% of the upside and none of the downside.
And that there's a statistic here, as well. So it grew 7%. Private equity, the amount of dollars in private equity grew 7% per year from 2011 to 2017, and then 18% per year from 2017 to 2023. And so we see that private equity, those dollars keep going up.
That's interesting too, because in 23 and 24, the major stock markets increased about 20% each of those 2 years, which means they outperformed private equity for.
Well,
if you're talking the amount of dollars.
What I meant was new dollars.
Yeah. Oh, okay. New dollars.
Yeah, new dollars.
Okay.
Investing in the.
Okay. New dollars coming in. Okay.
Yeah. So
but the investments themselves were mixed and are part of that 20% return for 3 years.
And that's one of the things that you were kind of talking about. It's hard to track the performance of those things.
And I think Warren Buffett ignores them altogether, or that's what he recommends. But I've seen him buy private companies before too.
Yeah,
but I'm sure he looks at all the financials.
I didn't check my sources on this, but I've seen that Warren Buffett, he was basically like, when I pass and my wife is all that's left, then let's just go index funds and we'll just stick with it like that.
He's made those recommendations before.
Yeah, so that's.
I heard him years ago
that he believes in the markets,
talking to college students. You should have bought my stock instead of spent all the money on tuition for your. You'd be well ahead of where you are now.
That's interesting. That's a hot take.
That's right. Yeah, but just because you did in the past doesn't mean it'll happen in the future.
We would say that education pays off. Yeah.
Some.
Yeah, that's right. Yeah, some education. Okay, so I mentioned it earlier. Private debt is another alternative investment.
Mm-hmm.
You can also invest in others' debt.
Yeah. Can you loan me
peer-to-peer lending, that kind of thing? Sure.
I'll pay you back.
Yeah, I would.
What interest rate do you want?
We'll have to talk about this. Okay, and then the last thing I was going to note is for some of these things, for the private debt and private equity,
yep.
You need to be an accredited investor, which means your net worth is over $1 million, or your annual income is over $200,000 if you're single, or $300,000 if you're married filing.
And does that net worth include your house?
I'll have to look at that.
We can. I believe it has to be.
In addition to
exclusive of your house.
Okay.
Yeah.
Okay. Yeah. So how do we sum all of that up?
Well, when somebody says, "I've got 20% alternative investments in my portfolio," I would say that really doesn't tell me anything.
I would agree with that.
Because there's such a diverse types of alternatives that term becomes meaningless.
Sure.
Similar to if I have 20% of my portfolio, like many of the college endowments have 20 or 30% in private equity or private debt, that really doesn't say much either. Because I could own a stock. If I've got $100 in stock, what does that mean to you? Like, is that a small cap stock? Is that an international stock? Is that
I think S&P, but we all think different things. Yeah.
Right. Yeah. So that is the first thing. Is alternatives is such a wide topic that just using that term is, if not meaningless, maybe misleading. But it sounds fancy.
Yeah.
So
sounds sophisticated, doesn't it?
Secondly, we would say if your advisor proposes alternatives to your investment, you would want to ask why, how does that align with my long-term goals, what are the costs and benefits of including it. Typically, alternatives have a higher expense ratio, particularly if they're managed futures and some private equity. Some of those funds take gains in performance as their income, so you don't keep all the gains, you share the gains. So just know that it is part of a strategy, and that a new offering to you or a new opportunity to come along matches with what you're trying to do in the long run.
Absolutely.
And then third is talk to somebody that knows what that investment is and why it should be good to you. You know, not just I heard that this is a good investment. What do you think? But
no, let's do some research.
Find out a little bit more about it. Well, recently we were recommending an alternative investment to some of our clients, and that took us 15 months
over a year
to do some research.
Yeah.
So, and we're the professionals, and we're taking our time to find out about it. So that's it. Be careful.
Yeah, and something that Michelle says a lot is it's easy to get into an investment. A lot of times it's hard to get out of the investment.
Yeah, many investments, not the ETFs and mutual funds, but many of the alternative investments are illiquid.
Yeah.
So you put it in, but
be wary.
Well, I have one that I've been trying to get out of now for quite a while. Yeah, it's not a day-long or a year-long thing. It's a multi-year process. Yeah. And particularly in bad markets, it's not like a stock that you can just sell on the open market because there's lots of buyers. So be careful.
Yeah. Absolutely.
Was it measure
Okay.
twice, cut once? Is that the?
Measure twice, cut once. Yep, that's it.
That's it.
Yep. You always cut the board and then it's too long. You cut it again and then it's way too short. That's how it normally goes. So,
Yeah.
Okay. Well, that's alternatives.
Good.
All right. Well, thanks for listening, and we'll see you next time on the Josh Brown Podcast.
Thank you.
Thank you for tuning in to today's episode of the Josh Brown Podcast. If you'd like to see more episodes, visit our website at joshbrown.com.